If you're thinking about making some money by investing in the stock market, you'll need to know a few things first. While it may seem easy enough, there are certain rules you should follow to ensure you're successful. By understanding and following these golden rules, you'll be on your way to making a killing in the stock market. So if you're ready to learn more, read on to find out what you need to do to make sure you're successful in stock market investing. In this video, we're going to be talking about the 10 golden rules of stock investing. If you're new to investing, or even if you're a seasoned investor, these rules are essential to success in the stock market. So without further ado, let's get started. Welcome to Coffeepo.com, where you learn finance every day. If you have not yet subscribed to our channel, please do, as we bring valuable information every day to keep you informed and updated about finances. 1. Never lose money. The first rule of stock investing, as famously stated by billionaire Warren Buffett, is to never lose money. This simple yet profound advice has guided investors for generations and is still as relevant today as it ever was. How do you never lose money in the stock market? The key is to always be aware of the risks involved and to diversify your portfolio so that you're never putting all your eggs in one basket. There are many different ways to lose money in the stock market, but the most common is to simply buy stocks that go down in value. To avoid this, you need to do your homework and only invest in companies that you believe have a bright future. It's also important to remember that the stock market is a long-term game. If you're patient and invest for the long haul, you're more likely to come out ahead than if you try to make a quick buck. So there you have it, the golden rule of stock investing. Follow it and you'll be on your way to a prosperous future. 2. Start small and think big. Investing can be a tricky business, and no one knows this better than Warren Buffett. The famed investor and CEO of Berkshire Hathaway has some sage advice for those looking to make a profit in the stock market. Don't lose money. It's certainly hard not to lose money, especially in a volatile market. But as Buffett points out, the key is to evaluate the risks before making any investment. If the potential rewards don't outweigh the risks, it's probably not worth it. This advice is especially pertinent today, as many investors are avoiding long-term bonds due to the current market conditions. The other key piece of advice from Buffett is to start small and think big. Many big things have small beginnings, and the same is true for successful investments. It's often best to test the waters with a small amount of money before investing a larger sum. And finally, it's important to take the time to learn about the companies you want to invest in. By doing your research, you'll be better equipped to make wise investment choices that could pay off big in the long run. 3. Think like an owner. When you invest in stocks, you are essentially becoming a partial owner of the company that you have invested in. And just like any other business, you need to think like an owner in order to make profits. Thinking like an owner means that you need to analyze the fundamentals of the company, its valuation, and its future prospects. You should also make sure that the company has a good management team, is in a good financial position, and has a competitive edge. By thinking like an owner, you can make sure that you are investing in a company that has a good chance of success and that you will be able to make a profit from your investment. 4. Invest only in business that you understand. Although it may have cost him profits in the short term, Warren Buffett's philosophy of only investing in companies that he understands has saved him from greater losses over the years. This is a principle that all investors should follow. Before investing in a company, you should understand how it makes money, its strengths, and the risks it's facing. If you don't understand the business, you're better off not investing in it. One example of a company that Buffett passed on investing in is Alphabet Inc., Google's parent company. While it's now valued at $1.47 trillion, Buffett didn't invest in it because he couldn't wrap his head around how the search engine could make money. Following this philosophy has saved Buffett from making some costly mistakes. If you're not sure about how a company makes money, it's better to stay away from it. 5. Don't try to time the market. Why you shouldn't try to time the market. Any investment expert will tell you that while you might have an excellent idea of the right valuation and price level of a stock, You should always refrain from trying to time the market. And here's why you can't do that. It's quite challenging to predict when a share will hit its peak or its bottom. As of posting this video, no one has managed to time the market despite checking multiple market cycles. Even the most sophisticated market analysis tools can only give you a rough idea of where the market is headed in the short term. In the long run, however, the market always goes up. So if you're patient and invest for the long term, you will eventually make money. There are two main reasons why you shouldn't try to time the market. First, it's very difficult to predict where the market is headed in the short term. Second, even if you could predict the market's direction, you would still need to be right about the timing of your investment, which is even more difficult. If you're patient and invest for the long term, you will eventually make money. 6. Always invest only excess cash. When it comes to investing your money, you should never put all of your eggs in one basket, so to speak. The stock market is always volatile, meaning that there is always the potential to lose money. That's why you should only invest the extra cash you have on hand, and not the money you need for everyday expenses. Budgeting and planning your investment is crucial in order to minimize the risk of losing money. By being mindful of your finances and investing only what you can afford to lose, you can help ensure that you don't end up in a difficult situation down the road. 7. Keep tabs on the trends. When it comes to investing in the stock market, there are a lot of different strategies that you can employ. However, one of the simplest and most effective strategies is to simply invest in the market and then let it be. You don't need to constantly be tracking your investments, as this can actually lead to more losses than gains. Instead, you should check in on your investments from time to time to make sure that they are still performing well. If you don't feel comfortable managing your own portfolio, then you can always hire a professional to do it for you. When you do this, you will need to provide them with specifications on how you want your portfolio to be managed. This includes things like how much risk you are willing to take, what types of investments you are interested in, and your overall financial goals. 8. Diversify your portfolio. There are a lot of different ways that you can go about diversifying your portfolio in order to minimize the risk of losing your money. One way would be to invest in both assets and instruments. For example, you could purchase an index fund like the S&P 500 and add a bond to your portfolio. Or you could invest in a real estate fund. Another way to diversify your portfolio would be to invest in different types of assets. For example, you could invest in stocks, bonds, and real estate, or you could invest in stocks, mutual funds, and ETFs. No matter how you choose to diversify your portfolio, the important thing is that you do it. By diversifying, you are essentially spreading out your risk and giving yourself a better chance of seeing a return on your investment. 9. Buy when everyone is fearful. When everyone is fearful, most investors will often sell or stop paying attention to the market. But don't follow suit, because that's when the bargains are out there in droves. That's right. The stock market is literally the only market when things are on sale. People are too scared to purchase. It's no wonder Mr. Buffett once said, "Be fearful when the others are greedy, and greedy when the others are fearful." Luckily, if you're a 401 𝐴 investor, once you set up your account, you don't have to do anything else to continue buying in. It's an excellent way to leave your emotions out of the process. This is why 401 𝐴 investors are often able to take advantage of market downturns, buying up shares at a discount. So if you're feeling anxious about the market, remember that your 401 𝐴 is still working hard for you, buying stocks on the cheap. 10. Learn from your mistakes. Locking in profit is one of the golden rules of investing because it enables you to earn regular income. When the stock market is moving up and down, it makes sense to have some money to trade actively and to realize some profit from time to time. And don't true out shorting. Locking in profit is a good way to protect your investment and ensure that you're making money. It's also a good way to diversify your portfolio and make sure that you're not putting all your eggs in one basket. When you lock in profit, you're selling your investment and taking the money off the table. This is a good idea when the stock market is volatile and you're not sure which way it's going to go. It's also a good idea to lock in profit when you're getting close to your goal. For example, if you're saving for retirement, you might want to lock in profit and invest the money in a more conservative investment. Locking in profit is a good way to protect your investment and ensure that you're making money. But you need to be careful not to lock in too much profit and miss out on potential gains. That's all for today. If you like this video, please give it a thumbs up. And if you want to hear more videos from our channel, subscribe and make sure to turn on the bell icon.